Welcome to the Ranchonomics Podcast, where we empower you to build a better ranch and transform your operations into a thriving business. I'm your host, John Haskell. Let's get started. Good afternoon. I want to welcome Bob Metzger to the podcast today. I have invited Bob here to talk because we keep hearing the same thing again and again. And we are recording this in August of 2024. And I keep hearing about how high markets are, and I keep hearing people talk about the desire to liquidate. So I want to get into, particularly, I want to talk about market timing today. But first, Bob, welcome to the podcast, and I would love it if you would give us an introduction to your professional background that makes you a particularly good person to talk about this topic.
Thank you, John. I grew up in West Texas and southeastern Oklahoma, went to school at Oklahoma State University, graduated with a degree in Ag Econ, went to work for Ag Edwards, which is one of the largest brokerage firms in the country, and I was vice president of investments with them for 30 years. Retired in 2009, devoted full-time to the cattle business since that time.
Very good. And you have a beautiful ranch in Hugo, Oklahoma, on top of a nice hill where there's always a little breeze and it's never too hot, right?
That is absolutely right. It very seldom gets over 110.
Yeah, good. Perfect. Your time with Ag Edwards, what did you do while you were with them, and where was your focus?
We managed client assets about $160, $170 million, and essentially stocks, bonds, mutual funds, and ETFs. We did a lot of bond business in addition to stock business.
Very good. And do you have sort of a general investing philosophy that you could share with us?
As it relates to the stock market, yes. And I think it could be overly simplistic. For the average person that can't devote lots and lots of time to study of individual stocks, I maintain that you should invest your money in index funds, which have very low expense ratios, put money in regularly, leave it there long term. When you see declines of the sort that we've seen over the last week or so in the markets, you certainly need to be staging in and adding more money if you have money available.
Is that a kind of a straight dollar cost averaging strategy, or is it just a continuous investment strategy?
I'm a big believer in dollar cost averaging in both up and down markets, because once again, if you say, well, the market seems relatively high today, so I don't think I'm going to invest money, that's faulty logic, because the market seemed pretty high the last time it made a record high for the last 30 years. If you continue to wait for meaningful pullbacks in the market, you're not going to be really dollar cost averaging very much.
Yes, very good. Let's get into the meat of what I want to talk about today, because you're kind of starting to touch on it. As the cow market is high, I hear a lot of people talk about, man, cows are high. I should just sell my cows and either become a custom grazer or just sit on cash or get out of the business entirely. I would like your thoughts on those. Now, again, I realize there's a difference between equity investing and cattle ownership, but there are some fundamentals underneath, I think, that are very much the same. And I'd love it if you'd kind of dive into that a little bit. So should I be a market timer? Should I be getting in and out of the market as the market goes up and down?
No, but essentially, I think a market timer, whether we're talking about stocks, we're talking about the cattle market either, I think you're going to be constantly like a dog chasing its tail. You're going to be behind all the time. It just doesn't work. Of course, my theory is if one is so brilliant that they can time markets, they don't need cattle to begin with. Maybe they do need to get out of the cattle business. All they need to do is trade cattle on paper. The futures market gives them a wonderful place to do that. You don't have to feed. You don't have to break highs. You don't have to do a lot of things. So if you're just going to guess the direction of the market, that's the perfect place to do it. But I wouldn't do it with livestock as such.
So there are a lot of people that tell us about what's going to happen in the future in the market, just like there are people that predict the weather. Are you aware of any of those people being particularly rich because they trade cattle according to their forecast?
No, quite the contrary. It doesn't work that way. Okay. Essentially, if you'll recall, John, at the start of the summer, all the university folks and all the predictors and so forth were saying, my goodness, cattle just have to keep going up, 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 up because of all these wonderful macro issues. You know, we got the low cow numbers, we got the cut out this and the box beef that, and all kinds of crap that they're throwing out. And what happened to price cattle over the course of the summer? They didn't go up. They went down, generally speaking. Am I correct?
You are. And I was just a few weeks ago, maybe a month ago, even now, at the Week in the Rockies sale over at Snowbird. And interestingly enough, I watched an incredible number of cattle sell there for a price higher than anyone has gotten before. And yet almost everyone there was disappointed,
Yeah.
everyone on the seller side. So at one point, the August, September, October futures were like at 280, 285-ish. A lot of cattle sold in the 250 range. Now, again, that, at it for an 800 plus pound calf, it seemed like steers kind of sold for about, these are fall delivery type steers out of the Mountain West, sold for, 21, 22, $2,300. And yet everybody was disappointed because we had an expectation, as you mentioned, that it was going to be much higher than that. So what happened? Was the forecast wrong? Like, does that ever happen?
Yeah. Surprisingly enough, it does. What I find is that lots of times there are a lot of folks out there that are interested in selling newsletters and so forth,
Mm-hmm.
and they just play to their market more or less. I think of an ag economist out of Kansas City that a number of years ago, a good friend of mine took his newsletter. And of course, this guy said, "You've got to be out of the market." We're talking about Standard Poor's now, and the Dow. You've got to be out of the market by March because and it was at 13,000 at that point in time. Because over the next year, from March, the next 12 months, it's going to be at 4,000. And he named 50 reasons why this was going to happen. You just got to get out. Well, my friend called me and he said, "Hey, what do you think of that?" I said, "I think the guy's full of crap, is what I think." I said, "Tell him that I'll put up 100,000. If he'll put up 50,000, we'll hold that in escrow. And if he's wrong, I'll take his money. If I'm wrong, he can take my money." The guy didn't take my bet. And the Dow was at 17,000 a year from then.
I've noticed over time that forecasters really are shy to take bets. Paul Ehrlich, I think, is the last most famous bet maker who trusted his forecast enough to make a bet, and he lost terribly badly. So
absolutely, so to say that the Dow is going to drop by 67% in the next 12 months, anything's possible. We could have a nuclear war and that could happen, but the probability of it is so slim that it's ridiculous to play with people's livelihoods. But there's a certain number of people out there that buy into the doom and gloom theory constantly. But when I talk about valuation, John, if I may, and I think this applies to stock. I think it applies to cattle. Number one, everyone has an opinion of what fair value of cattle are at any given time. Everyone has an opinion of what fair value as it relates to the stock market is at any given time. Now, some people are willing to assign a greater multiple to the stock market or greater value to cattle than others, but everybody has an idea of fair market value. Lots of times you'll say, "Well, golly gee, relative to my opinion, these markets are very, very high today." Or, relative to my opinion, these markets are very, very low today. Relative to my opinion of the market today, as opposed to what it would be at fair market value. But you may be right about the relative level of that market. It may be relatively very high, relatively very low, but that doesn't mean that it's got to move the opposite direction in the short term, because markets will remain drastically overvalued or drastically undervalued for extremely long periods of time. Just because they're undervalued don't mean they're going to go up. Just because they're overvalued don't mean they're going to go down in the short term. And if you don't believe that, look at the statistics about buying options, about buying puts or calls and placing your bet, because the devil in the detail always is the timing.
Right.
And that's why most people that buy options, betting on directional bets, that's why most of them lose money.
Right. And it's not because they got the direction wrong. It's because they got the wrong month.
They got the timing wrong. And they may have gotten the direction wrong too. But the time is the devil in the details, it seems like to me.
Yeah. Okay. So, and when you say long-term and short-term, what kind of time periods are we realistically, if the market stays overvalued for a long period of time?
I think it can stay for months and years.
Yeah.
Because in the shorter term and intermediate term, I think all markets to some extent are driven by emotion as much as they are by fundamentals.
Fear and greed, right?
That's right. And when you see a sell-off of the type we've seen in the last week or 10 days in the stock market, you went from euphoria 2 weeks ago to people, with their hair on fire trying to get out right now.
Yep. And we're in the period right now where especially tech has really made a good run, right? AI has been
Yeah,
driving things up. Amazon's been going up. Things have been hot, right? And suddenly we're seeing a
absolutely.
reversal.
Absolutely. And as it relates to the stock market at this point in time, remember the old Warren Buffett saying is that, you need to run when everybody's walking and walk when everybody's running.
And probably in the opposite direction, right?
Well, yeah, I mean, absolutely. Absolutely.
Okay, very good. So let's talk about the specifics of the risks of getting in and out of the market. You've got a great story of an investor you worked with in the late 80s
Yeah.
that I'd like you to share because I think this illustrates the point as well as anything.
Sometime in the spring of 1987, I sold an individual in Texas $100,000 of a mutual fund named Washington Mutual. It's in the American family of funds. It's a blue chip fund. Just started in 1952. Got a wonderful track record. So anyhow, we put 100,000 in this, and at that point in time, ETFs didn't even exist. Virtually all mutual funds were load funds, and so I think there was like a 2.5% sales load on this 100,000. So he started with 97,500. He'd been in several months, and it was somewhere in that range of 97,500. Along came mid October of 1987. The Dow dropped 22% in one day. And so he's down $20,000 overnight. He's got $77,000.
He was sure thankful to pay you commission, wasn't he?
Oh, yeah, he was tickled to death. He said it was really a great deal. And thank you so much.
Great experience.
Thank you so much for helping me with that tax problem I used to have. And so anyhow, he called and naturally he was upset. And he said, I've got to get out. He said, I just can't stand it. No telling what's going to happen with this market. What do you think? I said, I don't know what to think. I've never seen this happen before. But if you didn't know that a wreck was going to occur, how are you going to know when to get back in? He said, well, I don't know. But I'll figure it out. When I feel better about the market, I'll figure it out and I'll get back in, move it to the money market. So we move it to money market of the American family of funds.
And this is 1987, right?
1987, October 87. And by the way, the market had righted itself and regained all of that loss 13 months later. So it wasn't a long-term loss. By November 88, the market had righted itself completely. He didn't get in any time in that next year. He didn't get in any time in the next year. He didn't get in any time until 2009 when I retired. So that was 22 years after that market wreck. And he always had an excuse. Well, the market's been running up. Now it's too high. Well, golly gee, now in 94, where interest rates went up, the market went back down a little bit. So now I'm scared again. And I'm not making fun of the man.
No.
But when I retired, he had somewhere over 100,000, 105,000, 108,000, somewhere in that range. Whereas had he stayed, it would have been between 400,000 and 500,000. And so that was the cost of market timing or the lack of adequate market timing to that individual.
Yeah.
And I guess he may have felt like the rat, didn't want any more cheese, just wanted out of the trap. But you can't say I'm willing to be in something long term if you are jumping in and out. It's just impossible.
Okay, so if we are comparing that to I often think about investing in equities or in the stock market as an example, or in index funds as being comparable to being invested in cows within our ranch business. If we are looking for the parallels there, give me some ideas of how clear that parallel is. There are differences, but there's a fair amount of overlap, right?
I think there's a real fair amount of overlap. Of course, once again, I think about people just entering the market for the first time in, I believe it was 2015 when we were selling those $3,000, $3,500 bred heifers, and they've had a pretty hard time paying for them. So, having said that, a lot of these were people that were just getting into the market for the first time.
Yeah,
not people that have been in long term. So I'm not too sure, but once again, John, if you're going to be in, you got to stay in.
Yeah. And the joy of staying in, particularly if our time period is decades or even years, but preferably decades. If we're going to stay invested in cattle for the duration of our career, we are going to see ups and downs, right? But generally, if we manage our business correctly, we are going to be, taking the cash generated by that business and increasing our underlying investment, right?
Yeah, I mean, that's dollar cost averaging in and of itself. You'll be doing that. And hopefully, to some extent, you'll be using part of that excess cash flow to invest in other assets which are non-correlated to the cattle market.
Excellent. Yeah. Okay. But the one thing that's different about cattle versus stocks, and particularly when we're looking at index funds and broad-based market numbers, there is not necessarily an expectation that cattle prices will sort of, even if it's nonlinear, that they will go up and continue to go up, right? We can retreat back to historical prices in most commodities, right?
And will, generally speaking, yes.
Okay, so does that change?
That is a very good distinction also.
Okay, does that change how we think about it? I mean, when I think about commodities investing, the dollar numbers, we see real inflation and real deflation, whereas generally in the stock market, we see slower inflation, but not long periods of deflation.
That's absolutely true.
Okay, so do we change our strategy at all?
I still think not. I still think you have to be invested constantly.
Okay. All right. So there was a wonderful study done quite a while ago for a guy that was nominated for the Nobel Prize in economics, I believe. And he looked at what would have to be true for a market timing strategy to work. And of course, the thing that would make it work is having perfect information. And the fascinating thing to me was he had a character that he referred to as Peter Perfect. Well, Peter Perfect made every decision correctly every time. And what they found is that when he made every decision perfectly every time over a 20-year period, he made about an extra $500 a year. And if he didn't make every decision perfectly every time, he didn't make the 500. And I guess what my thought on that, thinking about the industry we work in, between weather and markets and, animal health and human things and all that, the politics, et cetera, that come in, our ability to make good decisions is pretty limited. And man, the upside of that $500 just doesn't seem very impressive.
Right. And it was $500 per what, John?
Per year.
Okay.
So over a 20-year period, it was $500 a year. So he came out with, $10,000 extra dollars in the end.
Mm-hmm.
Again, when I look at the cattle market and just look at, what are the real risks associated with a market timing strategy? And the reason I ask this is because I want to be very explicit about these so that we stay away from them. So, for example, your friend who wanted to get in at the bottom, right? He was having a very hard time predicting when to get back in.
That's right.
And so again, he strays from the example of Peter Perfect in that he doesn't know when the bottom is. So again, what are sort of the hallmarks of the risks of that market timing that allow us to sort of stay far away from that type of thinking?
Once again, I may not be answering the question right. I've just never seen it work. It does not work. Human nature is
like communism, right? It doesn't take reality into effect.
No. I mean, it's back to what we talked about a while ago, fear and greed. Yep. In this guy's case, by 6 or 7 months after that market decline, since the market had already regained quite a bit, then he was scared to get in because it was too high. But had it dropped back to a level below that October 87 level, I can guarantee you he would have sure been too scared to get back in then.
Yeah.
So emotions just come into play in a negative manner consistently. And so the only way to take emotion out is to stay invested.
And you allow that asset to ride the market up and then ride it down, right?
I believe so.
Okay. As I understand it, you are fairly cash flow focused, right?
Yes.
So you are continually in and out of the market, but the factor you have control over is the buyback, right?
Oh, absolutely.
Okay. So your risk management strategy is the fact that if the market goes down, then you are going to be able to buy back at a lower price. Is that right?
Somewhere on that continuum of the cattle market, whether we're talking about a 300-pound heifer or a 900-pound cutting bull, there is going to be something that is undervalued relative to other things, and that in turn will offer a reasonable buying opportunity.
Have you taken a sell-by marketing class and found that the emotion of the moment can make working through the calculations really difficult, especially when the market's really moving? We've developed a new marketing simulation focused on creating an environment to help you make money without getting lost in the emotions. There's a reason that first responders, the military, and athletes train in intense and realistic conditions. Success in their jobs is important, and their tasks are complex. It's true for you, too. It's one thing to learn it in a book, but it's quite another to practice it in real life. Our simulation program is designed to help you to be successful in the real world where it really counts. These sims offer you an opportunity to develop and refine your ability to work under pressure, think on your feet, and adapt to changing circumstances. Sign up today to be part of the Strategic Ranch Simulations event in Gillette, Wyoming on October 28th to the 30th. For more information and to secure your spot, visit www.ranching.fyi. All right. The other thing I want to make sure we emphasize here, and this is something I've tried to repeat a lot, and more so lately as I see it in action, even, sort of magnified. The world of investing speaks also about, compound interest and compounding growth. Do we have opportunities to do that in our own businesses?
I think so. You and I have a mutual friend, and that'll remain nameless, that over the last 20 years has averaged an ROI somewhere around 36-38% in the cattle business.
40%, yes, is a good round number to use there. Yep.
Yeah. And this is a real person. Many of your listeners know this man, and he's seen lots of up markets and lots of down markets in that last 20-year period that we've referenced. Yep. So can it be compounded? You bet.
And what's the importance of that compounding part? Because this is, to me, where the real action happens when we look at a career that spans multiple decades.
Well, just the old rule of 72, John.
Okay, refresh my memory on the rule of 72.
Well, if money is earning 10%, it'll double in 7.2 years. If it's earning 12%, it'll double in 6 years. Divide 72 by the rate of return.
Yeah, and my experience is
that having said that, if you start today with 100,000, and 12 years from now you have 200,000, it averaged 6% a year.
Mm-hmm. But when you average 40% a year, my experience is the rule of 72 is not a perfect predictor, but it's pretty darn good. The difference in doubling my money between 2.2 and 1.8 years, I'm willing to live with. Is that fair?
That's exactly right.
Okay, good.
Right.
All right. Compared with investing outside of the livestock business, turning to a quick comparison between equities and livestock, what are some of the differences? What are some of the advantages of each?
One of the advantages, obviously, of equities, one thing that was always attractive to me is that it's just about as passive as anything can possibly be. You can either invest on the growth side, the value side, or some combination thereof, which I think is always preferential, because if your portfolio is 100% growth, once again, your timing is going to be bad sometimes, and there will be a rotation out of growth into value and vice versa. There will be a rotation out of large cap into mid cap and small cap as well. So I think you've got to have diversification in all of those areas, but it's totally passive.
Hang on one sec. But when you say small, mid, and large cap, you're talking market capitalization. So
I'm talking market capitalization.
Yeah, explain that just a little.
Well, market capitalization, simply put, it's the number of shares outstanding of that particular company multiplied by the price of that stock on any given day. If a company has 1 million shares outstanding and it's priced at $20 per share, it's got a market capitalization of 20 million. Mm-hmm. And that would be a very small capitalization stock in today's world, where you've got market cap on Apple and Nvidia and Tesla and several of the what they refer to as Magnificent Seven, market cap over $1 trillion now of a number of those.
Right. Love it. Okay, so keep going with that. So fairly passive. I'm going to add to that, you have the ability to diversify a great deal with great ease, right?
Absolutely.
You can buy an index fund for a very low cost that sort of has a reasonable track record that does not require a lot of activity.
Yeah, absolutely. And once again, the concept of buying an index is that an index fund itself will outperform roughly 90% of the actively managed mutual funds out there. And it'll do it for a couple of reasons. Number one, the low expense ratio that you referenced. But number two, a mutual fund that stays within the parameters of its prospectus is limited as to where it can invest. And they may be all in tech, for example.
Yeah.
And golly gee, they just beat the tar out of the index for some small period of time.
Right.
But when there's a big rotation out of tech, they're going to lag the market also. So if you invest in the Standard Poor's 500, for example, you're going to participate in that market rotation as it occurs within the index.
So when the biggest companies are no longer the biggest companies, the index adjusts.
It should adjust over time, yeah, and always has.
Yeah, and we see that, I can't remember what the number is, but the average lifetime of an S&P 500 company, I want to say, is 20-ish years. Does that sound about right?
John, I don't know, but that sounds somewhere close to right. It may be a little more than that. Yeah,
it's not as long as you think, and I just look at the current suite of those Magnificent Seven, like you mentioned. How many of those companies were in existence when you were first starting your career?
Yeah, none.
And they may have been in existence, but nobody heard of them, right?
No, none of them were. And there's another thing about investing in stocks that is somewhat interesting to me. The number of publicly traded companies today versus 25 or 30 years ago is substantially less. And yet we have a growing population. People have 401ks, so forth and so on. And over time, if you have less of a product and equal to or greater demand, that in and of itself will give upward momentum. That doesn't mean every day the market's going to be up.
Right.
But it does mean that the probability is you've got more dollars chasing less shares.
Yep, that's right. Okay, so I'm going to cover a couple of just info things. When you say you talked about expense ratios, and you used a different word for it, and I apologize, but the expense of owning an index fund, when we are talking about no load or very low cost funds, you are talking about an expense ratio that starts with a 0 after the decimal point, right? So,
yeah, let's talk about that just one moment.
You bet.
It's not uncommon if we have a mutual fund, not an ETF, but if we have a mutual fund, and there are a lot of good mutual funds out there, and it sounds like I'm beating up on mutual funds. I'm really not, but because the average person with a good mutual fund, with a good family mutual funds, is going to have a return that's going to be in excess of what a bond or CD will do for them by quite some margin over time. But relative to that index fund, you've got an expense ratio with even the best mutual funds of anywhere between 50 basis points and 100 basis points. And that's 0.5% to 1%. A basis point is 1/100th of 1%. So if I say that I own a mutual fund and it's got an expense ratio of 1%, that's 100 basis points. Contrast that, for example, to the Vanguard 500, which has symbol VOO. It can be bought at no commission through Fidelity and E-Trade and so forth and so on.
Yep.
So you pay no commission to buy it, and it has an expense ratio of 7 basis points, if I'm not mistaken. It may be less than that.
Which is 0.07%.
That's right. That's 0.07 of 1%.
Right.
Is what that is.
Okay.
And so that doesn't take much off the top. But if you look at paying 1% with an actively traded mutual fund, which by the way is a low expense ratio for a mutual fund. But if you look at the effect that has on a $100,000 portfolio, paying 1% versus paying 7 basis points over a 10, 15, 20, 25 year period, it is absolutely
real cheese. Yeah, that's right. And
you're giving up 93 basis points a year on 100,000 over a 20-year period. I'll tell you what, you've got a happy broker, you've got a happy brokerage firm, but it's all at your expense.
Okay. Yeah, absolutely. And again, that's the problem with that is those 93 basis points. Not only is that money you pay to someone else, but that is money that does not get reinvested to continue growing for the 20 or 30
and hence there is no compounding.
Right. Correct. You've stopped the compounding.
Absolutely.
Yeah. Okay, good. And let's just real quickly, when you mention somebody like Fidelity, that is a brokerage. When we talk about Vanguard, they are an investment managing company.
Yeah, right? Well, Fidelity is an investment manager also. They have lots of ETFs.
They have their own
fund. And you can buy the Vanguard funds directly through Vanguard as well. You can set up a Vanguard account.
Great.
Fidelity account.
Yeah. Okay. But
and for that matter, you can buy the Vanguard fund through Fidelity for that.
Right. And Fidelity is one that I really like because they have a wide range of other companies' offerings available.
Yes, they do. And their website's real good also.
Yeah. Very good. Okay. And Fidelity also, I think, is one of these that has really pushed the fee. Now, my understanding is it Vanguard that really was kind of the first in this area.
Vanguard was the first. John Bogle was the father of index investing. In college in the 40s, of course, he used this as a concept that actively managed trading account can outperform the market as a whole.
Yep.
And he just laughed out of college, more or less. But it certainly proved that he was right. There's absolutely no doubt about it.
The fun part about his career is that not only was he basically laughed out of college, but then he went on to a fantastic failure, basically right out of the gate in his professional career, which he describes as a wonderful experience for which he is thankful because it gave him great humility and reinforced the point that he doesn't know as much as he thinks he does. Which, again, if you could ask for a gift earlier in your career, that would be a wonderful gift, right? You'd rather not learn that at 78.
Boy, isn't that the truth?
So it's a great story if anybody wants to read it. We decided to break this episode into 2 parts. So this is the end of part 1. Tune back next week to hear part 2. Thanks for joining us. Look forward to seeing you next week. Thank you for tuning into the Ranchnomics podcast. We hope this episode helped you win today. If you enjoyed this episode, please subscribe and share it with a friend.